Good afternoon, everyone. I hope you're having a good morning if you're in Europe. In Australia today, we had unemployment come out at an 11-year low. So if there's a country in the world that's probably provided too much stimulus to its country whilst having one of the lowest COVID cases in the world, it is Australia. But nevertheless, it's great to see unemployment well down like that and the Australian economy as big as it was before the COVID crisis. But again, we didn't have the case load that other nations have had, but we had similar levels of stimulus. Right now in Sydney, unemployment is low, but a lot of people are out in the parks and at the beach because Sydney's in lockdown. Case numbers in Victoria are on the rise. The regional spread of the virus around Sydney is growing. So we could be headed for a situation where both Melbourne and Sydney have lockdowns, simultaneous lockdowns, and that certainly won't be good for the Australian economy, employment, or the local markets such as the Australian stock market and the Australian dollar. Yes, I'm still very bearish for the Australian dollar. We said it was heading to 70 cents, above 77, 10% move for a currency. It's a very big call. It still seems to be headed in that direction. And whilst the Australian stock market has managed to continue to oscillate in the band of the last 3 weeks, it is looking a little on the day that it might be finally exhausted at trying to break to the upside. And as all the good news is now out, such as the employment figures, 4.9% by the way, dropping from 5.1, people are sort of saying, well, what better good news could we have? But still the market is stuck in this range. In China, of course, we had fabulous economic data out. Of course, it is weakening. It is rolling over from that post coming out of the crisis surge. I think what matters, though, is rather than the individual numbers, they're all quite high, by the way. Retail sales, fixed investment. GDP was only 1.3% on the quarter, but a lot of places in the world would love to have that GDP growth. So GDP growth is slowing, retail sales is slowing, fixed asset investment is slowing, but it's all from very high peaks and it's still at very strong absolute levels. So whilst the reserve ratio was eased in China last week, that was a preemptive move. I think China is going to have a soft landing to this rolling over slowing phase that it's now experiencing. And we have to remember that China is still growing at a phenomenal rate. So I would still be a buyer of Chinese markets. And US markets, meanwhile, are looking again, I know I've said this before and they've made record highs, but they are looking a little bit tired where they are. But the real bearish potential at the moment is that Australian stock market. In terms of currencies, still bullish the US dollar. I still think US firms are going to be repatriating funds back to the US as they become more self-assured of the US position versus the rest of the world. And that's going to continue to pressure commodities. And particularly the Australian dollar gets a double hit from that, both a firm US dollar and lower commodity prices. Out of all of that, though, I still very much like gold. So Aussie gold is still a favourite of mine, and I still expect that market to trend higher rather nicely. Every market has volatility, but that Aussie gold price action looks more reliable than most charts of late. This could be an idea for Australian gold miners, but certainly even if you're in Europe, you're in London, gold itself does look good and it could become very popular yet again if the Delta strain continues to cause supply chain disruptions here and there in an ever-evolving sort of rolling around the world fashion. Clifford Bennett, Chief Economist, ACY Securities, here in the park where we have near full employment in Australia. Thank you.